Hello guys, welcome back to Bong Lorette and this is Miss Suman. Today we are going to discuss about three topics, namely single and double entry system, books of original entry and bank reconciliation. But before that, let me remind you something that I upload 1 to 2 videos each week on SSC banking and other exams. So if you haven't subscribed to our channel yet, then please do so. And many of you are asking me about the expected cutoff of IBPS RRB Officer Scale 1 prelim. For that I need your help. I have given a poll on the top right corner of this video. Please select your number of attempts here. Then after analyzing the responses, I will publish the expected cutoff within next 7 days. So now let's go to our class today. So our first topic for today is single and double entry system. A business entity can record its monetary transactions either on single entry system or double entry system based on their requirement. The former is less laborious as well as less time consuming, while the latter completely records the transactions which need substantial effort and time. Single entry system of bookkeeping is economical, but at the same time it is unscientific because it does not record all transactions, rather only a few ones are tracked and some are recorded partially. On the other hand, double entry system of bookkeeping is based on fundamental principles of accounting, and so it records each and every aspect of transaction. I think all of you have understood what it is trying to say because the language is very lucid and no accounting jargons have been used yet. But if you haven't understood, then there is nothing to be anxious because I'll be giving examples and it will be clearer. So now we will go to the double entry system. Double entry system is the scientific method of keeping financial records developed by Luca Pacioli in 1494. The system is based on the principle of duality. That is, every transaction has a dual aspect. Each transaction affects two accounts at the same time, in which one account is debited while the other is credited. So far, whatever we have learned was according to the double entry system of bookkeeping. That means the basic concepts of financial accounting, its nature, scope, then conventions, then the basic equation of accounting, all were based upon this double entry system of bookkeeping. I think it is clearer now. That means that for every transaction, two accounts will be affected. One account will be debited and one account will be credited, as we have seen in case of ledgers. Right. Now we will go to the single entry system. So what is it? Single entry system of bookkeeping is the oldest method of maintaining financial records, in which an entry is made for every financial transaction. In this system, the corresponding opposite entry is not made because the transactions are recorded only once. So this type of bookkeeping is the oldest method, as it says, and it is also the simplest, and it is also the time effective system. For small size businesses or for storekeepers or the small vendors, they usually follow this system because it is not very laborious and you don't have to be a professional to keep records of your financial transactions following this method. And it says that each transaction is recorded only once. Why? Because there is no need for making ledgers or trial balance. So once you are done with the transaction by making a monthly or some periodical summary of all the transactions, that is all. Then it says full record keeping of transaction is not done due to a single entry of every transaction. It mainly keeps track of the transactions related to cash receipts and disbursements. So let me give you an example. We will take the example of Mr. Kapoor again. Mr. Kapoor has a store and he wants to keep track of all the financial transactions of his shop. Alright. He wants to record that on some specific date, some Mr. X has taken 1000 rupees goods from him on credit. He doesn't need to check whether his account is debited and Mr. X's account is credited or not, because he has nothing to do with it. He just has to know that Mr. X owes 1000 rupees to him. That's all. I think it is clearer, and here an example is given, and in this example 3 columns are there. First one is for date, second one is for the transaction details, and the fourth one is for the amount. Okay, now we will go to the second topic. Our next topic for today is books of original entry. Books of original entry refers to the accounting journals in which the business transactions are initially recorded. The information in this book is then summarized and posted into a general ledger from which the financial statements are produced. Each accounting journal contains detailed records for the types of accounting transactions pertaining to a specific area. Examples of these accounting journals are cash journal, general journal, purchase journal, sales journal. So in our example, in the previous class, we have seen only 5 transactions were listed. Now suppose for a company or institution, there are 1000 transactions each day and 10,000 transactions per month. So will it be very feasible to use only a single journal? I think not. So in that case, the accountants use several journals for several type of accounts, like the cash journal, which is used for financial transactions or monetary transactions. Then the purchase journal, which is used for the purchased goods or services, and the sales journal, which is used for sold goods and services only. So now we will see the applications. Books of original entry are extremely useful for investigating individual accounting transactions and are commonly accessed by auditors who verify a selection of business transactions to ensure that they were recorded correctly. So it means that whenever an auditor checks the financial statements of a company or institution after a certain period of time to clarify the transactions listed in the statement, he has to verify it from the original book of entry. I think I am clear? Okay. So this concept only applies to manual record keeping. A computerized accounting system no longer makes reference to any of the accounting journals, instead recording all business transactions in a central database. So it says nowadays all the transactions of any big company or institution are maintained by computers, and there is no place for books of original entry in that. Those transactions are directly listed into the central database and used for further processing. I think it is very clear to you all. Now we will go to the next topic. Today's last topic is bank reconciliation. A bank reconciliation is the process of matching the balances in an entity's accounting records for a cash account to the corresponding information on a bank statement. So after the end of each month, the bank sends a bank statement for all your financial transactions associated with the bank, and then the accountant matches the transactions in his book, maybe a manual or a digital book, with the bank statement. So what is the objective? The goal of this process is to ascertain the differences between the two and to book changes to the accounting records as appropriate. That means it helps in pointing out any mistake or any error, also helps the accountant to rectify them. The information on the bank statement is the bank's record of all transactions impacting the entity's bank account during the past month. A bank reconciliation should be completed at regular intervals for all bank accounts to ensure that a company's cash records are correct. Otherwise, it may find that cash balances are much lower than expected, resulting in bounced checks or overdraft fees. A bank reconciliation will also detect some types of fraud after the fact. This information can be used to design better controls over the receipt and payment of cash. That means suppose your bank account has zero or very low balance and you pay somebody with check at that time. So what will happen? The check will bounce. I think all of you know that what bouncing of a check means. It means that the check could not be encashed due to insufficient balance in the giver's account. Alright, so we will go to the limitations now. It is extremely unlikely that a company's ending cash balance and the bank's ending cash balance will be identical, since there are probably multiple payments and deposits in transit at all times, as well as bank services fees, penalties, and not sufficient fund deposits that the company has not yet recorded. What it is trying to say is that generally the bank's record of your financial statement and your personal financial statement does not match, because whenever you pay somebody by check, you record it in your book, but maybe the receiver of the check does not encash it immediately. So the bank would not know about the check you have issued and it will not record that in their books. So there will be a mismatch, and then there are certain bank fees that the bank deducts from your account without informing you beforehand. So for these reasons, the reconciliation is not always efficient. Okay, that is all for today. In the next class, we will know about types of errors in accounting and how to rectify them, and after that I will start classes on banking awareness and Indian banking system and RBI. It will help you in SSC exam as well as in the banking mains. So stay with us. If you have not subscribed to our channel yet, then please do so, and please like and share this video if you think this video is going to help you. Thank you all.